Today, a stats fest on credit, home prices, and GDP. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and problem news with a distinctively Australian flavour. Well, we've been inundated with data over the last couple of days, and a lot of it is pointing in quite different directions. So I thought we would walk through some of the critical data. And we're going to start with the latest GDP number, which was actually a little stronger than many people expected. The ABS said that the Australian gross domestic product rose 0.8%. That's in seasonally adjusted chain volume terms in the March quarter of 2022. And it was up 3.3% through the year, according to the ABS statistics. And that means that the economy grew for a second consecutive quarter, following a contraction in the September quarter of 2021, when, of course, the economic activity was affected by Delta. Now, if you look at the data in more detail, household and government spending drove growth this quarter, with total final consumption contributing 1.4 percentage points to GDP. Household spending rose 1.5%, with increases across a number of discretionary categories. In other words, we spent and spent big. Household consumption continues to drive growth for this quarter, and that's of course following the easing of the COVID-19 restrictions. So household spending on transport services, hotels, cafes and restaurants, and recreation and culture all increased. A lot of that is discretionary expenditure. In addition, government consumption contributed to a rise in domestic demand, with increased expenditure to support flood-affected regions in New South Wales and Queensland, and the weather events during the quarter affected supply chains and dampened activity in industries such as construction and mining. The fall in mining production led to a decline in exports of mining commodities, resulting in a 0.9% drop in exports. And the other interesting point is that the household savings to income ratio fell from 13.4% to 11.4% as the increase in household spending outpaced growth in household income. Household gross disposable income rose 0.6% in March, driven by a rise in compensation for employees, reflecting robust employment and labour cost pressures. And households, though, also received $2.8 billion in non-life insurance claims relating to floods, adding 0.8 percentage points to the saving to income ratio. And it's worth noting that the 11.4% household savings ratio was the lowest since the start of the COVID-19 pandemic, although it does remain above pre-pandemic levels. So just trying to put that into context, the reason that the GDP number was slightly stronger than expected was because households were spending and spending big. A lot of that spending went on discretionary items rather than necessities. And it was also supported by strong prices for our commodity exports. And of course, the imports also were tweaked a little bit, thanks to the fact that we needed more things to be brought into the country, and also businesses stocked up on inventory. But the underlying trajectory, though, is still of some concern, I think. But of course, it's stronger than was expected. Now, something else that came out just yesterday was the latest financial aggregates from the Reserve Bank. And this, of course, gives us a read on the total amount of credit in the system, and it includes both the banks and the non-banks. And interestingly, they said that in the year to April 2022, total credit grew 8.6%. That's compared with 1.3% a year ago. Credit for housing grew 7.9% compared with 4.4%. Personal credit was still falling at 2.8%, but not falling as fast as a year ago when it was 7.9% down. And business credit was 11.6% higher compared with 2.9% a year ago. And in the month, total credit was up 0.8%, housing credit was up 0.6%, personal credit was up 0.3%, business credit growth was 1.4%, and broad money was up 0.5%. Now, what we can also do is to look at the data in a little bit more detail. And to do that, we'll look firstly at the monthly movements. Now, these monthly movements, of course, are very volatile, but nevertheless, they do give you some sense of what was going on. So housing grew 0.6% over the month. And that comprised owner occupation, which was at 0.59%. compared with investment lending at 0.63%. So for the first time for a long time, there was more lending for investment purposes than for owner-occupied housing, just ahead this time. That's a significant change, and that may wake up the regulators in terms of tighter credit controls. Personal credit was at 0.26%, so that was quite strong. And business was 1.37% higher, so a significant rise. Now that is again very volatile, but significantly higher this time. And we can also look at the total aggregates. So all credit grew 0.82%, which was pretty strong. And the broad money was at 0.55%, so it's down a little bit, but still quite strong. And that, I think, also includes some of those insurance payouts that we mentioned before. Now we can look at also the annual numbers, and they smooth out some of the humps and bumps. So over the last year, credit for housing grew at 7.9%, so way above inflation or indeed wages growth. And amongst that, owner occupation was at 8.99%, whereas investment was at 5.76%. And I'll highlight again the significant rise in the investment lending. It's got really hot, and that's one of the reasons why credit is still extremely strong. Property investors are saying, well, I'm not getting much in stock markets, so I'm using my money now to buy into real estate. And by the way, a lot of that real estate transaction activity is actually in regional areas and in places like Adelaide. So that's where interstate investors are looking at the moment. Personal credit was down 2.83% over the year. And lending for business was at 11.64%, which is extremely strong. It's stronger than it's been for quite a long time. Now, some of that is because of the issues with cash flow, thanks to supply chain constraints and rebuilding inventories, as we discussed earlier. And we can also look at the aggregate numbers. So all credit grew by 8.61% over the last year. And broad money is at 9.71% higher than a year ago. And you can see that there was a significant rise in 2020 thanks to the government's intervention. Then effectively it fell away and it's been rising again. So there is still a lot of money sloshing around the system at the moment. And that's one reason why the credit momentum is still where it is. And I will just go through the 3-month aggregate. This is the one I tend to look at to get some semblance of where we're headed more specifically. Housing is 1.79% and is easing back just a little. Owner occupation is at 1.85% and is easing back more. And investment lending is at 1.72%, is actually moving up. So once again, it confirms my hypothesis. Investment lending for property is still pretty hot, hotter than it's been for quite some time, in fact. Personal credit was at 0.18% over the 3 months, so it is moving into positive territory. And lending for business at 2.8% over the last quarter is pretty strong. Some of that is for just keeping cash flow in hand. It's restocking inventory. Not a lot of it is actually for business investment. Now, we can then move on and look at the other set of data we get from APRA. This is the monthly Authorized Deposit-Taking Institution statistics, which currently summarises the loan balances at the banks. And the first number to bear in mind is $1.982 trillion. That is a record. That's the total amount of lending relating to housing that the banks have made. It continues to grow. And you can actually see how that plays out The owner-occupation lending is very strong still. The investment lending is still growing, even if a little, and therefore the proportion of investment lending is at 33.13%. And I should explain that the kink that you see there from the previous couple of months was the restatement between the two categories, which we covered last month on the show. Now we can also look at the change on the month. So owner-occupied loans grew by 0.53%. Investment lending grew by 0.48%. Again, last month, you've got to ignore those points because essentially they are distorted because of the restating of balances from some of the banks. But overall, lending was up 0.51%, which, by the way, shows you that there was stronger growth potentially in the non-bank sector compared with the ADIs in the last month. Now, it's also worth looking at the portfolio movements. Macquarie was extremely strong on both investment and owner-occupied lending. NAB was stronger on owner-occupied. CMEO the same, although they did lend for investment purposes. And you can see that some of the smaller organisations are getting quite strongly into investment lending, including Suncorp, HSBC, Bank of Queensland, and even Citigroup. It's also worth noting that Australian and New Zealand Banking Group Limited, which is over here, the reason it's there is because this is sorted on owner-occupied lending. Their owner-occupied lending portfolio continued to slide, whilst they've opened up the aperture to the investment sector. And this is further confirmation of the fact that the investment sector is getting quite hot at the moment, and so there's quite a lot of competition, and the banks are seeing quite a lot of opportunity to lend more there. Now let's move on to dwelling units approved. This is again from the ABS. And the ABS said that total dwellings approved fell 2.4%, with private sector houses rising 0.5%, while private sector dwellings excluding houses fell 6.1%. Now, of course, as I've said before, this is quite a volatile series, particularly the non-house segment of the market, because, well, if you actually get approval for a new high-rise apartment, then you're going to have a large dwelling count, and of course they are much more lumpy. So the high-rise sector is still active, but not as active as it was. Housing, though, is more interesting. There's still significant momentum there, as some of the lead time relating to home builder and some of the other programs are working their way through. And of course, we know that a number of builders are really struggling at the moment simply because they can't get the parts and they can't get the people to build, which is slowing up some of the processes around approvals as well. And the value of non-residential building approvals fell 30%. And a quick look at the movements by state. You can see there that the monthly change was down 6.8% in New South Wales, down 4.5% in Queensland, up 10.6% in Tasmania, up 7.8% in Victoria, and an amazing 50.3% change in South Australia. Now, given the small numbers there, I suspect that's a statistical anomaly, and it's something to do with the fact that there was probably a high-rise approval in the numbers. So I wouldn't get too excited about the 50%. Overall, though, the total dwellings approved fell 2.4%. And I'll also highlight the fact that we have more units than houses being approved across the country. And of course, that mix is most adverse in New South Wales, Victoria, and Queensland. And just a little bit more information on the value of total buildings approved. It fell 12%. The value of total residential building increased 4.7%, following an 18.7% fall in March. And the rise in total residential building values was driven by a 6.6% increase in alterations and additions, and a rise of new residential buildings of 4.4%. And one of the things I want to highlight here, going right back to the other data set, quite a lot of people are raiding their savings to invest in alterations and additions to existing property. it's sometimes more effective to convert or change your existing property, add a room or rooms, than actually trying to move, because of course the cost of moving includes stamp duty and other costs. And whilst that may sound a good idea in theory, of course, if you can't get the builders and can't get the parts, you might well find the costs are higher than expected. But nevertheless, a number of households are investing at the moment in approvals and in changes to existing properties rather than new properties. And just before I finish, I want to just cover the latest home price movements from both CoreLogic and PropTrack. And this is a pretty important set of statistics. Now, of course, as I've said on several occasions, these numbers are always wobbly. They tend to be delayed and they tend to be averages. But nevertheless, over time, the trends do tell a story. And what CoreLogic has said is that over the month, the combined dwelling movement overall, nationally, was down 0.1%. And that was comprising of 1.1% over the quarter and 14% nationally over the year. And there were falls over the last month in Sydney and Melbourne, down 1% and 0.7%. And also a small fall in Canberra, the first time for a long time. And as a result of that, the combined capital cities were down 0.3%, despite the fact that Brisbane was higher, Adelaide was a strong 1.8%, Perth was 0.6% and Hobart 0.3%, and Darwin was 0.5%. And it's also worth noting that the regional areas continued to move up 0.5% over the month, 3.6% over the quarter, and 22.1% annually. And if you compare the annual movement in the regions at 22.1 compared with, say, 10.3% in Sydney or 5.8% in Melbourne, you can actually understand why it is that people are still buying in regional areas. Now here's a chart showing the rolling 3-month change in dwelling values across the state capitals, with Adelaide leading the charge at 5.7, then Brisbane at 4.6, Perth at 2.7, Melbourne down 0.8% and Sydney down 1.4%. So it is certainly underscoring the fact that when you put interest rates up, the momentum with regard to prices goes the other way. We'll see more of that ahead, of course, as the RBA moves rates even higher. And it's also worth just again stressing the difference between the dwelling values in the combined capitals versus the combined regions. And you can see there that the regions are still moving down a little, but the combined capitals much more so. And that, of course, is distorted by Sydney and Melbourne being large centres with big moves. And finally, the PropTrack Home Price Index for May, which also came out, shows a somewhat similar story with falls over the month in Sydney and Melbourne, a very small fall in Hobart, and a fall in the ACT, but rises in Brisbane, a strong rise in Adelaide, and a small rise in Perth. And once again, the regional areas show a stronger set of momentum, particularly in the rest of New South Wales, for example, as well as South Australia. And whilst their calculations are completely different in terms of the data sets and how they actually come up with the numbers, the overall trends are relatively similar. So my expectation is that we're going to see more price falls ahead as interest rates rise, that the momentum will be weakest, particularly in Sydney and Melbourne, and particularly in the high-rise sector, while some other capitals and some regional areas probably will also turn down a little, but later and not so deeply. Now, I think that'll be determined by how quickly the Reserve Bank lifts rates, how far they go, and at what point do they stop. So a lot to watch. So just to summarise, if we put all this together, we can see that the credit momentum was quite strong, although the data looks as though ahead will be weaker. Home prices are on the turn, particularly in Sydney and Melbourne, and potentially elsewhere as well. The GDP was propped up by significant savings being spent, and of course there's a limit to how far that can continue. And the vagaries with regard to the overall situation remain pretty strong. So they said the Australian economy grew 0.8% during the March quarter and 3.3% over the past year. Strength came from household consumption, which grew 1.5%, and from a record $7.5 billion ramp-up in inventories. The inventory build-up largely reflects the business community replenishing stocks. Household spending was strongest in the eastern states, most affected by Delta wave restrictions in the second half of last year. The ACT at 3%, Victoria at 2.7% and New South Wales at 1.9% saw the strongest growth in household consumption in the March quarter. The Omicron wave and the devastating floods in New South Wales and Queensland did hit the labour market during the quarter, with hours worked falling by 0.9%. And more broadly, the unemployment rate was 3.9% in the month of March, which was the lowest unemployment rate since August 1974. Now, we continue to eat out, and we've started travelling again. The purchases of food from supermarkets and other retailers fell 2%, but spending in restaurants, cafes and pubs surged 5.3%. With the Australian border reopening in early March and restrictions on international travel lifted, spending on transport services grew a whopping 60%. The consumer prices rose 2.1% during the March quarter 2022 and 5.1% over the year. That was the fastest quarterly growth in consumer prices since the September quarter of 2000 and the fastest annual increase since June 2001. The major drivers of consumer price increases were housing and fuel. Wage growth trailed inflation despite a strong labour market. The wage price index rose just 0.7% during the quarter and 2.4% over the year. Quarterly wage growth was strongest in the education, arts and recreation and admin and support industries, and most of the wage growth came from individual and collective arrangements between employers and employees, as opposed to awards. So there you go. In a nutshell, we have a problem insofar that income is not growing, whereas costs are, that the momentum is being driven primarily by households using their own savings and by continued government handouts and government spending. Not hugely productive, I fear, and as a result of that, of course, our overall productivity is continuing to go backwards. The bottom line, of course, is we need to change the trajectory, so it'll be very interesting now to see whether the new government does take the task up or whether it simply apes what's already gone before. We'll have to wait and see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.